NVIDIA and Marvell, two semiconductor companies that are really focused in the AI data center market, saw a downgrade today by the same analyst at Citi. So, on today's episode, what I want to do is kind of take a closer look at what this analyst sees, kind of share my overall points, and maybe why, in the long term, I think there might be something wrong with the overall thesis. So, let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so if we look at right now, in the past 5 days, NVIDIA has dominated, right? Monday was when we saw the scariest of scares so far. But if you were able to pick up at the bottom on Monday, you would be up roughly 26% right now. I think that's insane, and it's a perfect reason why one doesn't try to time the market. Now, Marvell Technology still pretty good in the past 5 days, up about 12%. If we would have looked at its peak, though, the stock would have been very similar to Nvidia, up nearly 27%. But on Wednesday, the stock did kind of take a hit. So there's a lot of fear and questions surrounding Marvell right now. And one of the things that, in my opinion, I believe Marvell's equipment solutions and networking solutions are a little bit more tied to the Chinese market in forms of products. And their tariffs might not be, and the tariffs impacting there can definitely impact Marvell a little bit more. So first, let's kind of start off with the analyst, and this analyst is coming from Citi. They have trimmed its earnings and sales forecast for both NVIDIA and Marvell Technologies, pointing to lower cloud capital expenditure expectations and persistent macro uncertainty stemming from trade tensions. So, I mean, in a quick way to look at it is if we see kind of this increased tariff growth, and if a good portion of products that are coming in from the data center for the data center infrastructure and the data center market are coming from China, if you still, let's say, have a company that's spending $100 billion about a month ago, right? They said they were going to spend $100 billion. Now with tariffs and getting things and things becoming more expensive, that $100 billion technically is going to buy you less. And if it buys you less, then that means those other companies that are dealing in the AI data center market are going to sell less, right? So that's the overall, I guess, fear, and kind of on the top level approach is your $100 billion of capital expenditure means less right now than it did a few weeks ago, because things are getting more and more expensive. So the only real things that we can see is either an improvement in increasement of capex, or a lot of these companies either not increasing the prices and taking a margin hit. And I don't think many companies are going to do that. So obviously that $100 billion in this random example is going to buy less and less data center products. So in theory, it can create kind of a slowdown in data center expansion. There are some other things I'm going to look at, but for Nvidia, Citi lowers its calendar year GPU unit forecast by 3% and 5% respectively for 2025 and 2026. So not only are they kind of expecting a slowdown here in 2025, they're also expecting a slowdown in 2026, as hyperscaler growth projections were revised to 35% and 15%. Previously, I think it was like 45% or growth for this calendar year, and about 15% and about 20-something% for next calendar year. So Citigroup, what they're really saying is capital expenditure that they thought was going to happen this year and next year growth is not going to materialize anymore. It's actually going to be smaller. So not only is data center worth less now in forms of the dollar, your capex is worth less, the overall growth that we're going to see because of macroeconomics is not going to be as high as before. And I think here is where we see a lot of weakness. Now, we'll go back to the overall analyst in a bit, but Jensen Huang kind of really explains it perfectly in a recent Q&A session in GTC. And he mentions that right now, when you kind of have all these multi-$100 billion billion capex projects that are coming, that are projected, not many people are counting a lot of these AI factories and these multi-billion-dollar projects that are not from the hyperscaler. So, for example, we would have to kind of look back and we can look here. They mentioned hyperscaler growth, and the hyperscalers are typically like your Microsoft, your Amazon, your Google, and your Oracle. And they mentioned that one of the big reasons is it reflects the move of Microsoft capex concerns and higher risk of pause in enterprise investments amid uncertainties around the global economy due to the ongoing trade war. So there are also a lot of other companies like CoreWeave that are buying a lot of AI infrastructure. There's I forget a few in the top of my head right now, but these are not. I think nowadays you can't just really be focusing in capital expenditure from Microsoft and the big giants. You have to also look at these other cloud server providers, because what we are seeing is kind of a shift that maybe Microsoft might not be building that, but we are going to have that same capacity being built out by CoreWeave or these other players, and Microsoft will gladly rent it out. So we're seeing the Riskify move a little bit into other places where it's no longer going to be too heavily impacted by these major cloud providers, especially during times like right now. I think during times like right now, the big tech is going to be like, I don't want to take the risk, but I know CoreWeave and all these other cloud infrastructures are going to want to take my money right now so they can build and buy more AI infrastructure. It's cheaper for me, but they are still going to be paying the bill and buying those GPUs, right? So I think that's the first thing, as no one wants to slow down. I mean, you have projects like Stargate as well, which we don't know if this kind of Citibank analyst has that projected, or if he's just really caring about the big three or the big four when it comes to the cloud market. So Jensen mentioned it perfect, that a lot of these analysts are not projecting a lot of these multi-billion-dollar investments coming from all different entities for AI infrastructure. And I think that's something that investors should consider when listening to kind of these bearish theses from Citi about the data center market. Now, in forms of price target, they reduced the price target to 150 from 163. Now, Marvell was also affected by the same macro overhang, particularly concerns over Microsoft's capital spending and broader AI demand. So they overall slashed the company's expected revenue estimates by 5% and 8% for the next 2 years, and reduced their price targets from $122 to $96. Not only that, though, this kind of analyst is also seeing some concerns about their ASIC solution, which they provide Trainium for Amazon, and they believe that Amazon might be looking for other players to do this instead, which can overall cause some negative pressure for their overall ASIC solution. So again, to me, I can see why data center slowing down could be a short-term impact for companies like Nvidia and Marvell. But I also could see that just the spending might be shifting away from the big tech players and going out somewhere else to de-riskify a little bit. Now, depending on how macroeconomics impact, you could see kind of maybe a slowdown in a data center today, or a pausing in data center. And to me, I think this could create better buying opportunities in the future. If one wants to add is, in the upcoming quarters, right, we might hear, you know what, with the trade wars, we are not stopping our data center investments, but what we're going to do is we're going to pause maybe for a month or two as we wait all these tariffs to really finalize and we really understand things. And that 1 or 2 months can kind of make it seem like GPUs, ASIC solutions are no longer a thing and the demand is not there. But a lot of these companies, because this is multi-hundred-billion-dollar investments, they're going to want to make sure that they know everything right and they try to save as much money as possible. So this uncertainty that's going with tariffs, I can definitely see maybe a potential slowdown in data center projects, but not due to the lack of demand. It's more to the lack of information that they need to continue. The other thing that I want to say is capital expenditure is not as easy as, hey, look, if Amazon is spending $85 billion in capital expenditure, it's going to be 50-50. 50% goes to AI chips. The other 50% goes to overall infrastructure. depending on how much infrastructure has already been built, and it's very different from each company. In theory, if let's say this $85 billion example, the first year, maybe you did $45 billion went to AI chips and $40 billion went to AI infrastructure as you build massive, massive data centers. But next year, let's say you go down a bit, you go to 80 billion, or let's say you stay the same, you stay at the same $85 billion in capital expenditure. But this time, the spending within there could be different. You can say now, because we have built up all these data centers, now is the time we fill it up with chips. So instead of doing 45-40, which we did last year, we're going to do something like 60-25. We don't need to build that many more data center structures, but we are going to be buying more AI chips and more networking solutions. So I think this is why capital expenditure is also something that we shouldn't truly focus on, because even though there could be a time where capital expenditure as a total number doesn't grow or even sees a decrease, the amount of money that can go to semiconductors, AI chips, and networking solutions can still be increasing within that pie. So things to consider here when kind of being a little bit fearful of just capital expenditure. Now, I just want to kind of finish off this episode by looking at some charts and some financial numbers. Here we can see Nvidia's forward PE ratio trading at 24. I still believe this is pretty cheap, and we've gotten some great buying opportunities. I believe the market is going to be volatile, so there could be future opportunities as well. Now, Marvell Technology sitting at a forward PE ratio of 18. This is insane. Again, this one probably has a little bit more risk. Actually, a lot more risk than Nvidia. It is a smaller player. They have strong competition against Broadcom here, or a competitor with Broadcom here. But still, trading below 20 on a forward PE ratios as a semiconductor company, I like that a lot. Now, one thing, I also wanted to just look at revenues for those that are not familiar with Marvell Technology and Nvidia. Here in the red, this is their data center market, and everything else that I kind of stacked up here is all their other solutions. They focus on kind of like the consumer market, which is the blue, the industrial market, which is the orange. We also have kind of the enterprise networking, which is the green. And overall, and then carrier infrastructure, which is kind of like the purple. Overall, we can see that AI and data center revenue pretty much are the biggest driving force for this company. About $1.4 billion this most recent quarter, where about only $450 million came from all the other markets together. So if there is a slowdown for data centers in the short term, we can see that the other markets are still pretty weak for Marvell, right? We are in a down cycle. We can see just in 2022 how they were pretty high, almost a $1 billion here in quarter four of 2022, and they kind of dropped down to less than $500 million now in quarter four of 2024. So we can kind of see this cycle of their other markets. So even if those other markets pick up, but we do see kind of a slowdown in data center, that can definitely impact Marvell dramatically. So any hiccup in data center, in my opinion, can definitely create even more negative pressure for the stock. But overall, I believe I'm very, very bullish for both Marvell and Nvidia. For Nvidia, a little bit more. Nvidia is my biggest position. Marvell is one that I understand the risk, and I would never ever make it like a number one, number two, number three position, but it's one that I don't mind holding exposure to. Here we can see Nvidia's kind of total revenue versus their data center revenue, and you can see how heavily dependent they are of this. So to me, the biggest thing and biggest takeaways before I look at some other notes is data center. We could have a hiccup in something, and maybe some data centers taking a quick pause as everything comes to light and more information is needed. And if we do see that, I think the market will kind of see that as an extremely red flag, where in my opinion, it would be more of just, I understand. I mean, if prices are increasing, a lot of your infrastructure and products are coming from China, you're going to want to wait back and see, hey, should I wait the 90 days until a deal is made before I purchase anything? Should that be the smart thing to do? And I think most people are expecting some form of deal in the future. So if you could just wait it out 2-3 weeks and still save hundreds of millions or billions of dollars, Why wouldn't you? But the market might not see it like that and might just see it as kind of like, hey, look, this is the signal of oversupply and overcapacity in the data center space. And I do believe that could create great buying opportunities for the future. So short-term hiccups, in my opinion, create opportunities. Long-term, I still am very, very bullish for data center spending. All right, so I have one more thing to share here, and this is from Marvell Technology CEO. He was recently at a conference on March 11th of 2025. About a month ago, but still before the tariffs. And one of the questions was actually, hey, we're hearing rumors about Amazon maybe kind of looking for another customer. Marvell Technology says that they can't really share a lot of these stuff because a lot of the stuff is go through NDA, so they can't say, you know what, this is fake reports because that we already signed the deal with them to kind of do the next generation and generation after that of the Tranium. So they can't really say that. But what he does say is he has framed a long-term opportunity for Marvell in the AI space, and people could just read whatever they want with that. But to me, he's telling me, hey, look, I can't necessarily say we have good deals and great partnerships with Amazon, but what I can say is that the growth opportunity for me looks pretty good. So that's all I have here for Marvell and Nvidia. I mean, like I mentioned, they both got downgrades. I can definitely see the reason being in the short term of things, but I think the short term headwinds might create fear that the long term thesis is broken, and I believe it's actually it's actually completely wrong. I think the short-term headwinds, if they do happen, don't really have much to do with long-term demand. So overall, still very bullish for Marvell, still very bullish for Nvidia. If I am only able to pick one, obviously I would pick Nvidia without a heartbeat. So take care, have a good day, and see you all next time.